Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors. Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. You know, in this episode, I want to get into kind of market rotation and market volatility. We've been publishing a lot about both on things like stifelinsights.com or our CIO Weekly Insights email. We've issued what are called market pulse reports. So basically, if the S&P 500 moves down or up 2% or more, then we're going to publish this thing typically. And even in our normal market perspectives publications like the weekly market weekly market perspectives, which again, you can check out on stifelinsights.com. Basically, what we're talking about is that we've seen a softening job market, weaker manufacturing, and even a very small rate hike by the Bank of Japan has sort of thrown things into a tizzy. And what I want to do in this episode is get into a little bit more of those forces. So recall, we've been talking about a market rotation more broadly in the sense that the Magnificent Seven big tech stocks have been driving this sort of upwardly moving market. And we talked about a broadening of the market and maybe that dominance sort of rolling over a little bit, where really we marked it as July 10th as the date where that started to happen, where generally those stocks and the overall cap-weighted market might have rolled over and gone a little lower, but the average stock was actually not rolling over as much. And in fact, for a period, the equal-weighted S&P 500 was posting a modest positive return. So think of it as sort of the guidance we've been offering about not capitulating and shifting from, let's say, an equal-weighted to a cap-weighted strategy, things like that. And we were talking about this inflection point, which again sort of occurred on July 10th. In the wake of that, though, we had a couple things happen that, or a few things actually, that have sort of triggered an increase in market volatility and a downward move in the equity market. And I just wanted to get into those forces almost as a setup for what we're seeing when we look forward over the next few weeks. So let's start with manufacturing. So basically, there are these indexes called Purchasing Managers Indexes. They're essentially a survey of business leaders and managers. And the idea is that they're sort of normalized to the number 50. If the reading is above 50, then the activity that's being discussed is expanding. If the number is below 50, then that's a signal that the area is contracting. And so anyway, ISM did their manufacturing PMI, they issued it, and the punchline is it came in at 46.8, which is pretty well below 50 and lower than what was expected. I think it was expected to be just slightly below 50. Anyway, punchline is that's signaling in manufacturing and a contraction. On a related note, construction spending in June declined 0.3%, which again is not good, right? It's a slight decrease, but the consensus view is for expansion for 0.3% increase. And so that differential kind of has weighed on things. Now, second thing, which was actually discussed at the Fed meeting, or by Fed officials and Chair Powell at saying his press conference after the Fed meeting, is this idea of a softening job market. So unemployment, anyway, we've got a report. Unemployment jumped from 4.1 to 4.3%, kind of unexpectedly. And related to that, the economy created 114,000 jobs in July, which in absolute terms is not a bad number, but the expectation was for 175,000. So that differential, right, round numbers around 61,000 fewer jobs than expected, that sort of weighs on people like, hey, the economy is slowing down relative to where we think things are going. And so all this is adding up to market volatility, an increase in market volatility, as well as a decline in the equity market. And so to kind of jump into that a little bit, the S&P 500 actually, and just think of this window, from July 16th to August, which was sort of a local peak, to August 5th, which is sort of where all this news had hit and kind of been absorbed. The index was actually down over that interval, 8.4%, so approaching the correction level of 10%. And when things like that happen, there's what's called a flight to quality. So in theory, people are selling stocks, they're wanting to buy safety, they go to treasury bonds and bid up treasury bonds, which means that their yields fall. So the 10-year treasury yield, as a point of reference, has declined, and in turn, bond prices have gone up, which means the bond market has posted a positive return. And so, similarly, to look at a specific interval, the 10-year yield had peaked on July 24th, a local peak of 4.3%, and it's fallen basically down to 3.7% on that same date, August 5th. And so that's, again, the idea that there's a flight to quality, a demand for treasuries. And so over that specific interval, rates fell. And the Bloomberg Aggregate Bond Index, remember, when rates are falling, prices are going up. So that bond index actually posted a positive return over that period of 3%. Now, in the background here, kind of, I think it's the end of July, Bank of Japan raised its key rate. It's sort of their Fed funds rate by just a quarter point. They're kind of talking about inflation, worried about inflation. They decided, hey, we're going to raise rates by a quarter of a point, which isn't a whole lot. But essentially, a number of hedge funds and other investors have had what's called a carry trade on. And the spirit of that is, look, you borrow money in Japan at what is really a low rate, and then you sell those yen, buy something else. Often it's the US dollar, right? Exchange the yen for dollars, and then go buy something. Could be investing in the equity market, could be investing in local cash. And so that you're earning potentially a return higher than what you're using to pay for that debt. It's called a carry trade. Anyway, long story short, the view is, even though we don't get great transparency in this, that this one rate move caused a number of sort of program-driven hedge funds to have to unwind that trade. You know, the last estimate I saw, which might be a little stale, but you get a sense for the scale, was 200 billion of notional basically has to be sort of unwound. And the punchline is that creates sort of this mechanical selling pressure on the market, which amplifies both the volatility and sometimes the downward move. Now, one final note back to sort of this discussion about Magnificent Seven is most of them have reported second quarter earnings, and kind of earnings were mixed. So that's added to sort of the nerves in the markets. So think of it as, hey, we've had a number of things sort of hit, really off the tail of what's been a very positive equity market. So it's a very natural thing for the market to roll over a little bit. And, the reality is we're not even yet at a quote unquote correction. So, we've given up the last, 2, 3, 4 months of gains, but it's not like we're in any kind of crisis right now, at least. And so what that causes us to do, of course, is to try to understand, when we look forward, what are some things that might trigger markets to go in a breakout way, and breakout meaning it could be positive, could be negative. We don't really know. So we have coming up, and I'm sure I'll be talking about this as the episodes are produced in the wake of these data points, but we have inflation. So we have both a consumer price index and the producer price index coming out next week. And of course, everyone's looking at that because the Fed has indicated that with a cooler labor market, I think they believe inflation will remain under control. And that causes them to say, hey, we may be getting to a point where we can cut rates. But of course, if inflation surges, then that goes against what investors are expecting. So we should expect some increased volatility and potentially a downward move if inflation surges. On the flip side, if inflation remains cool, sort of that evidence that the Fed's looking for, that things are lining up for a sort of a setup for them to cut rates, then they could cut rates in September. And that is either going to sort of support levels of the market or potentially move markets higher depending on their signaling and all of that. Now, that's sort of the whole story with the Fed and interest rates and things like that. The other thing, of course, is we've seen these few cracks. We've seen some cracks in consumer-related data like sentiment and confidence and retail sales. And so this idea, which we've been talking about for a while, of a slowing consumer, as that data rolls out, does that reality kind of kick in with people in terms of where we're headed with the economy? Right now, the consensus view for sure is for a soft landing, meaning, the growth is going to slow down, but stay positive, and we're not going to hit a recession really soon. And so, again, that's something that everybody's sort of focused on. And every once in a while, you'll see a news headline pop up, hey, we're in a recession. The general view is we're not there yet. We're seeing a slowdown on a number of fronts, and the market meaning investors, economists, investors, everybody's kind of processing it to figure out sort of where we're headed from here. Anyway, I think the punchline for sure is, hey, for long-term investors, I wouldn't get overly stressed about this. These kinds of things happen. It's really, really hard to trade the market, meaning, oh, I better get out because there's volatility and then try to get back in. Long-term investors should stay the course. I would be talking to your financial advisor about rebalancing, making sure you're aligned with your long-term strategy. We've talked before, if you have cash, as we anticipate the Fed cutting rates, this is a good time to put cash back to work. And that could be, I want to invest. Let's say you need the cash in a couple of years for some remodeling or a trip or something. Buy some bonds that sort of align with that horizon, lock in those yields. Or if that cash is really aligned with your long-term or intended for your long-term strategy, it's a good time to start almost like a methodical process to get reinvested. So again, talk to your financial advisor about that. Listen, that's what we wanted to cover. Again, we've got a lot to talk about next week. Thank you so much for listening, and we'll catch you on the next one. Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.